investment research firm that provides info to both investors as well as businesses to help them make more informed decisions. The way we provide those companies valuable insights is through our process, which we call channel work, which essentially means networking with people across the industries that we cover on a regular basis in order to get a boots on the ground view of industry trends, how they're impacting core markets, and get a bottoms up view rather than a macro view. So within the fluid power industry, we've been doing the FPDA survey for over 15 years. I do want to take this opportunity really quickly to kind of plug the survey. I think this is one of the great benefits of being a member of FPDA. The information is very helpful. It helps you understand the overall business environment, helps you benchmark your performance against the peers, and it comes at no extra cost to being a member. So the more people that participate, the better the better the input that we get into the survey. It allows us to create better output for you. And with knowledge being power, I think it's a really good benefit to take advantage of. But that's what we're going to do today. We're going to kind of talk about the overall business environment, touch on some of the key macro headlines, both tariffs and inflation, and then dig down into, the fluid power industry specifically, see what the trends there in the survey have been recently, what key end markets stand out, and of course, talk about what's on the come here in 2025. But with that, let's get started with the hot topic of the day, which is tariffs. I think it's worth highlighting here that with tariffs, there's a ton of unknowns, lots of moving information, and I think anyone on this webinar knows as much as I do about what Trump's next move is going to be. I was just at a building show, and I talked to a large building product supplier, and he said, everyone here has the same limited information and is trying to communicate it in a way that sounds more sophisticated than the next person when no one really has a clue. And while that to some degree is the truth, we're going to be able to provide you an insight of how we're thinking about tariffs with the information that we do know today. This chart here just provides an overview of the U.S. trade landscape today, who our top trade partners are, and obviously Mexico, China, and Canada, the key ones to pay attention to, as these are the ones where the tariffs have been in communication most. I think it's worth highlighting that Mexico is our largest importer at 15%. If you back up, several years ago to when Trump's last administration, when he announced tariffs, China was originally our largest trade partner. But over the past several years, there's been a lot of efforts to reshore and move production both domestically as well as to Mexico. So we've seen them take the top spot. But as of right now, the only impactful tariffs are the ones on China. This kind of gives an overview of the tariff timeline since Trump has taken into office. A lot of headlines changing hour by hour. There was one morning when Trump announced tariffs. We put together a report, sent out an update, and within an hour, they were all delayed by a month. But right now, the tariffs that are in effect are the 10% tariffs on all imports coming from China, as well as and then what's going into effect is the 25% tariff on steel and aluminum from all countries. Trump did announce 25% tariffs on both Mexico and Canada, but those have both been paused as both of those countries have shown some flexibility in negotiations. So as of right now, those are delayed until March 4th. Unclear whether those are going to go forward or not, but right now we're operating under the assumption that only the China steel and aluminum tariffs will be going into effect. A lot of potential noise and changing headlines around tariffs, but I think the most important one to call out is just the overall uncertainty that it brings to the economy. People know how to operate when they get bad news, but when there's uncertain and changing news, it makes people's jobs a lot harder. It makes pulling the trigger on decisions tougher, weighs on CapEx decisions, and I think this kind of shows how much of the chaotic environment the tariff situation has created. This is an index that measures uncertainty specific to trade policy, and as you can see, this is the highest the index has been since the last time we were in this tariff trade war environment in 2018 when Trump was last in office. Of course, the other impact that should be paid attention to is the potential impact on inflation. This chart here shows the overall change to inflation if these tariffs are going into effect. The flat line at the bottom is the base case of assumptions without tariffs. And as you can see, that the overall aggregate impact of tariffs on inflation would add around half a percentage point. And when the Fed is currently at 3% and targeting 2%, a half a percentage point in the wrong direction is pretty impactful. When we talk to a lot of the distributors and suppliers across the supply chain, They frequently say, hey, we're just going to pass this on through price increases. Our suppliers have announced a price increase. We plan on fully passing it through. During the last environment, this was really effective. The demand environment was a lot stronger at this time. What I don't think a lot of people are taking into consideration is the broader impact on inflation. A lot of people in their assumptions for 2025 are assuming that interest rates are coming down, but with tariffs potentially pushing inflation up, the likelihood of interest rates coming down could be moving down, which is slowing the overall macro environment. Which kind of brings us to the next key topic here, which is the Fed and their impact on overall inflation. Like I said, headline consumer inflation right now is sitting at 3%. That still is above the Fed's long-term target of 2%. It's much lower than the peak that we saw in the summer of 2022, where core inflation peaked at around 9%. What I think is really important to remember is that while inflation is slowing, the 3% is versus last year. So while the rate of inflation is moving down, we're still significantly higher at price points across all product categories than we were prior to COVID. And we're still, working to move down. The Fed, their focus is to balance inflation while managing the labor market. As you can see here, the labor market's still pretty healthy. I think the chart that's most important here is the overall unemployment rate in the top left there. Unemployment moved down to about 4% in January, slightly below where it was at 4.1% prior. This is near a record, all-time low level of unemployment, so very healthy market. I do think it's worth highlighting that there have been more layoffs recently, companies announcing a return to office and what people are calling ghost layoffs, as the return to office forces resignations. And then with Elon Musk and the Doge efforts, we've seen 75,000 government employees accepting their severance packages. So unemployment pretty healthy at 4%, potentially moving slightly up, towards a bit higher, but nothing concerning at this time, still really healthy, which puts the Fed in a tough position because the labor market is healthy and inflation is still ahead of their long-term goal of 2%. And as a result of that, the Fed recently has taken a more hawkish stance, saying that they're not going to increase or decrease rates as quickly. The gray line here shows the projected Fed actions timeline backing up. This was the expectations for how the Fed was going to move with interest rates as of September 23 or to September of 2024. But as you can see, with Trump coming into office and this tariff policy, the expectations are for inflation to stay more heated than initially expected, which is slowing down the level of rate cuts that are expected to come here in 2025. And some economists are already saying that there's potential that we don't get any cuts at all this year. So the overall impact, certainly worth paying attention to. I think it's really important, even though, this is an industrial sector, to highlight the overall impact on the consumer, as they are 2/3 of the economy here in the United States. Here, consumer confidence, as you can see, took a drop recently in the last month. It was actually the largest drop that we've seen in over a year, with consumers most frequently highlighting tariffs and concerns around growing inflation or reversing inflation, cited as most frequently as the driver for the drop in consumer confidence. And that's showing up in consumer balance sheets. I think this slide is really interesting, shows how the average consumer is dealing with the inflation, essentially having to take on more debt to get through their everyday life. Credit card balances, a higher percentage of overall income, increased delinquencies on those credit cards. And as you can see, that overall percentage of debt relative to the consumer's balance sheet is moving up, following really low levels when the government was injecting stimulus into the economy. But now I want to kind of zoom in onto what we're seeing specific to the overall fluid power industry, how it impacts you and the other members of the industry that you guys play in here. I think this chart is always really helpful to look at, kind of looking at the key events that have happened over the past 8 to 10 years here. And as you can see, the last time Trump was in office and when he won the election, there was a large rush in recovery. CapEx started flowing really freely. Tax incentives were more attractive. And you saw a huge recovery coming out of the 2016 oil and gas recession. But as you can see, once he put those tariffs into place in middle of 2018, that recovery started to lose some momentum. And we started to see the industrial economy slowing down even ahead of the COVID shutdowns. Then in March of 2020, we really saw a shutdown. the economy came to a screeching halt, and then pretty quickly people realized that they could work remote, and you saw a very drastic recovery, which we saw a really strong demand environment. I think it's worth highlighting that a lot of that growth from 21 through 22 was driven not only by strength in the underlying markets, but inflation adding quite a bit, with suppliers announcing much more price increases than normal. But then, as inflation became more of a concern, as you can, the Fed started to hike interest rates in late 2022 and early 2023, which has caused a bit of a slowdown that we've been seeing throughout 23 and 24, which hopefully is showing signs of a bottom here now in early 2025. Looking at trends more recently, these charts come from the Fluid Power monthly trend survey. So this is from all the other members across the association here. But if you look at sales over the last 6 months, I'm tracking down around low single digits on average. Quite a bit of volatility month to month, but if you look at the orange line, that's a 3-month moving average. And as you can see, stepping down, declining year over year through late in the back half of 2024. Most of that weakness was largely attributed to weakness in mobile OEM markets, specifically agriculture, with it taking another step down in 4Q, and Cat and Deere both cutting production outlooks for 2025. But what's encouraging here to see is that in January, it's only 1 month into the year, but we are seeing that stabilize. Sales were actually positive against very tough comparisons, and that 3-month moving average starting to show some signs of stability and a bit of a trough here. Still below expectations on the sales side, but what's more important and more encouraging is what we're seeing on the orders side. This chart just shows, outside of the Fluid Power survey results, that other industrial economic indicators are showing some signs of stability and a recovery as well. If you look in the top left, industrial production showing a nice uptick there. And looking at orders, I think this is, the most encouraging trend that we're seeing here in early 2025. Following a pretty protracted slowdown with orders, declining throughout the back half of 2024, it seems like orders are showing signs of recovery. In January, both sales and distributors reported positive order growth, and that was against a very tough comparison. And what's also encouraging is not only is the data getting better, but the commentary and our conversations are a lot more optimistic. Talking to a lot of distributors, over the last several months, the comments were, orders are only moving down. It's the worst month we've had. Ag is dragging sales down. And the tone changed quite a bit in January, hearing a lot of comments like, still not where we want to be, but this is the best order input we've seen in 12 months. This is the first time we've seen orders exceed sales in over a year, and a lot of optimism around the improvement in quoting activity. While orders, are flat to up slightly here in January, we're actually hearing quoting activity is well ahead of that, ramping pretty consistently since the election, with some distributors calling out quotes up double digits this time last year and getting better each month. So while orders, showing signs of stability here, it's encouraging to hear the commentary from the channel as well, saying that, hey, this is sustainable. We're seeing signs of green shoots and signs of life here. And with comps getting easier in February and March and quoting activity ramping, it seems like this trend is not just a false bottom, and it should be sustainable, with orders expected to continue to recover here into the first quarter. What's also worth highlighting, looking at some of the large industry players, both Parker Hannifin and Gates recently reported their fourth quarter earnings and highlighted similar trends. Parker highlighted orders inflecting positive for the first time. And I think one of the really interesting comments from their earnings calls was that they said historically an industrial downturn lasts around 6 quarters of negative orders, or 6 quarters of no growth across their orders. Because of the weakness that we're seeing in ag, it seems like that typical cycle is going to last 7 quarters, but we're currently in that 7th quarter. So seeing the stabilization in orders is encouraging, and would expect that to flow through to sales. Sales still negative here in the first quarter, but would expect those to inflect positive into the second calendar quarter of the year. Now moving on, from sales and orders to channel inventory dynamics. Overall, we're hearing generally that inventory levels are relatively in line with end demand. This chart shows orders across distributors and manufacturers. going back to 2009. But if you can see a pretty huge divergence in these two lines throughout 22 and 23, as manufacturers were significantly underperforming distributors as a result of heavy destocking. During the COVID environment, supply chains were extremely tight. This forced distributors to order well ahead of demand, place stocking orders, often placing blanket orders that usually they would place monthly. They were placing all at once for placing 12 months of inventory all at once. So then once supply chains improved, inventory levels were really excessive, which forced distributors to have to destock throughout 23 and most of 2024. But now we've seen that inventory levels appear to be more balanced. Most of the distributors that we talk to consistently tell us that they're largely in line with where they want to be. They feel that they have enough product to meet end levels of demand. And they don't plan on restocking soon. I think one thing that is worth highlighting and important to call out in this cycle, historically, when we start to see trends bottom, you see distributors starting to place stocking orders to get ahead of an improvement in demand. We don't really seem to be seeing that this round. I think what we're hearing from a lot of distributors is that they still are pretty cautious given the uncertainty around tariffs and the Fed keeping rates pretty high here. So until they see a few more months of positive order trends and continued momentum across quoting, it seems like there's a little bit of resistance to place some of these blanket orders and start restocking. It's also worth highlighting that supply chains are in a much better position than they were prior to COVID. People are much more confident in their ability to get product quickly if they need to in recovery. So from a distribution standpoint, we are seeing that inventories largely aligned. Don't expect any stocking or destocking events heading out into 2025. But what is worth highlighting is the OEM part of the channel here. Even though distributors consistently report to us that their inventories are largely in line with end demand, the inventory sentiment index in the survey consistently reads too high. We're still hearing distributors frequently tell us that they have too much, or we hear participants telling us that there's too much inventory, which really is not aligned with what the distributors tell us. And the answer here is tied to what we're seeing at the mobile OEMs. Ag customers, ag dealers still sitting extremely high on equipment inventories, which is causing the OEMs to place a lot less orders. Even though end demand is weak, that weakness is being exacerbated by the fact that the channel still has elevated inventory levels to work through. And we'll kind of dive a little bit more into the details there. As we talk about some of the key end markets that really stand out to us across the overall economy. I think this chart here shows the aggregate of all 17 end markets that we track monthly in the Fluid Power survey. What's really encouraging to see is in January here this inflected positive, following a long projected downturn, and we saw 15 of the 17 end markets all improve versus in January versus December. If you look at it month to month, as you can see, almost all end markets looking better than they were, and even the end markets that were the most weak, especially ag, forestry, and automotive, seeing less severe declines than they were prior. So, some of the better end markets got a little bit better, and the worst end markets got less bad. This takes a look at the different end markets from a different perspective. The orange line being the specific end market, and the blue area chart being the overall aggregate of those specific end markets. And we'll send this PowerPoint out so everyone can look at these more closely, but we'll dig into a few of the specifics that I think are most important, kind of having an outsized impact on the overall fluid power economy here. I think the one that I've already talked about a bit here, that is the most impactful and the loudest in our conversations is agriculture. As you can see, significantly underperforming the overall survey. When we talk to distributors, sales will be tracking flattish, and they're saying, hey, our overall sales are flat, but our customers in the agriculture space are down double digits, 15-20%. And you could see that significant underperformance here with the orange line well below the overall aggregate index here. We have a team here at Cleveland Research that's focused specifically on digging into the ag market, and they do a quarterly agriculture dealer survey. And this shows the results from that survey. If you look at the net versus plan row, a net 58% of ag dealers finishing below plan in the first quarter, the fiscal first quarter of 25, which is calendar 24Q of 2024. But not one single dealer finishing ahead of plan, and the majority of them coming in below plan. And that's with sales declining about 12% on average. And remember that while the ag dealers, their sales out the door are down 12%, they're still sitting very heavy on inventory, which is weighing even further on the OEMs. This chart here, also sourced from that agricultural dealer survey, shows the respondents' view on their inventory, similar to the inventory index in the fluid power survey, but this is all ag dealers. And as you can see, 89% of dealers nets reporting that inventory is still too high. It is, the first time we've seen some improvement from what we were seeing last quarter, where nearly every single distributor or dealer was saying that inventory was too high. So it's encouraging to see this moving in the right direction, but still have a long ways to go. The feedback from most of our contacts across both suppliers and distributors suggests that inventory is likely not going to be normalized until the end of 2025. And with the recent production cuts, this could actually potentially linger into 2026. So, while the overall industrial economy seems to be showing signs of stabilization and recovery, ag is the one market that we expect to remain very challenged and kind of drag on the overall rate of recovery for the broader industrial economy here. The other market that stands out, I think, and is worth highlighting just given the overall scale of this end market, is automotive. As you can see, the automotive industry has been soft and also underperforming the overall industrial average. What I think is, the key driver here is two things. One, end demand has been very soft. We already talked about the consumer being weak. Interest rates are high. They cannot make discretionary purchases. So the end demand for these auto OEMs has been very weak. But what's also been tough is navigating through the EV transition. All of these OEMs went all in on EV, and they kind of were betting a bit too early. So they've had to pivot their strategies back to ICE engines, hybrid engines, and this has reshuffled, their CapEx budgets, but they're also their production and overall spending. Just this morning, we saw that 2 battery plants projects that were supposed to go forward in 2025 were both completely canceled this morning. So, the overall ag industry or the overall auto industry struggling from soft demand and in this EV transition that the OEMs are trying to work through. So expect that softer production to weigh on their spend from a fluid power perspective. From a more positive standpoint, I think MRO, no surprise here, continues to be very resilient, in any end market, whether, the economy is growing or slowing. Don't see MRO generally being the leading indicator, generally tracking above the overall industry, more resilient economic, more resilience to the economic cycles. So not surprising to see MRO still tracking ahead of the overall. Also, starting to see some of the consumer markets showing signs of recovery here. Food and bev and life sciences tracking well ahead of a bit above the average, and also showing some signs of improvement here. Just recently, Rockwell Automation, while not a perfect gauge to the overall fluid power industry, but they operate in similar end markets, automation spend. And they recently reported a reacceleration in orders, calling out both these specific end markets as seeing an improvement in more green shoots, which is encouraging to see here. Aerospace is also consistently called out as one of the best end markets in our conversations. I think the commentary that we hear in our conversations is actually a lot louder than I think this chart shows. It really kind of just shows it just tracking in line, but we hear spend is very strong in these categories, particularly from the space exploration companies. SpaceX, Blue Origin, highlighted as spending a lot of money. But we also, Parker Hannifin recently reported and also continues to call out much better than expected results in their aero business, both in the overall aero segment as well as the aero that goes through their distribution business. So continue to see aero as a bright spot in the economy heading into 2025. I think one market that's really important to call out and is becoming a bigger and bigger conversation piece within the fluid power industry is data centers. This has always been something that, has come up in our conversations, but was more on the edges. But just in the last 12 months, more and more distributors are saying, hey, we're seeing a lot more data center opportunities popping up, and each of those opportunities turn out to be bigger than we initially expected. Seeing some of these customers order out 1, 2, and even 3 years. And this is all, of course, driven by the AI hype. I think the metric that's really interesting and worth highlighting here is that the 4 hyperscalers, which are Amazon, Meta or Facebook, Google, and Microsoft, are expected to increase their CapEx budgets by 35% in 2025. And that follows a 75%, over 65% growth in CapEx that they saw in 2024. And to put some numbers around that, that's that 35% growth in CapEx that's expected to happen in 2025 is just among those 4 companies alone averages to about $300 billion in spend. So the demand for data centers is just massive, and as the new chips that are used to drive AI are installed, they require more liquid cooling, and more liquid cooling requires more fluid power components. So think that this is one of the most attractive end markets. That's going to be a huge growth opportunity in 25 and beyond. And we're hearing a lot of companies, both OEMs and distributors, are investing in the space. OEMs are investing in incremental capacity on certain product SKUs to support this product or this end market. We're hearing some companies are forming data center specific sales teams, and distributors are looking to do the same thing. A lot of these hyperscaler sales go direct to the OEMs, but we are still hearing that distributors are able to get involved in the sales process, and we think this is a market that you should definitely be focused on and looking to get involved in if you're not already. And while the overall end markets, we're seeing signs of recovery, I think it's really important to highlight the impact of inflation and price increases and how that's going to have an impact on the overall trajectory of growth in 2025. If you look here, this shows the fluid power sales over the past several years and breaks out, the total sales number and strips out the price contribution. So you could look at just sales and just in volume and see how inflation contributed to sales growth, with inflation being represented by the orange there. As you can see, during the COVID supply chain environment, price contributed much more than historically has, over 5% to growth. We actually had to, at the time, adjust the survey to support, the higher responses to inflation that we were getting. But as demand has slowed, we've seen, volume and dollars realigning here, as you can see, basically overlapping in more recent months. But this has been, driven by 2 factors. One, we've seen suppliers announcing less price increases, but given the soft demand environment that we've seen in 2024, we've also heard in our conversations a lot more competitive pressures being highlighted, more foreign competition entering the market, and customers, given that things were a bit slower on their end, having more time to shop around, push back, look for better deals on cost, which has limited the impact of price contribution. But that normalization seems to be coming to an end here. If you look here at the chart on the left, the estimated price contribution starting to tick up off of a sharp decline. You see it troughing and starting to show signs of recovery. And on the chart on the right, the price versus prior month starting to move up off of a trough there. Part of this was happening prior to the election. We were already seeing a lot of suppliers starting to announce price increases, kind of in line with historic norms, low single, mid-single digit price increases. But following the election, and the impacted the tariffs that are expected to go into effect, we expect this trend to continue to move up. Price overall is expected to contribute around 1 to 2% to sales growth right now, but with the potential impact of tariffs, that could move high as 3 to 4% and potentially higher if the tariffs on Mexico and Canada do go into effect. So that brings us overall to the 2025 outlook and overall forecast. A lot of moving pieces, tariffs, interest rates, ag end markets, but overall, based on all the respondents across the survey, people in the fluid power industry are forecasting sales to grow about 3% on average in 2025. The outlook progression here showed by the blue columns. If you back up a few months, coming into the year, most of our contacts were expecting sales growth in 25 to only be flat. a big cause of that was the inflation environment and the uncertainty around the election. Following the election, once that uncertainty got removed, people sounded a lot more optimistic, people thinking that the new administration is going to be more pro-business. So you saw that outlook go from flat to up low single digits. But since then, even though we've seen orders and that quoting activity stabilize, we have not seen that outlook moving up since November. And the biggest reason there is because of the tariffs, creating uncertainty, limiting, adding a bit of caution to the overall environment, potentially slowing the overall pace of recovery, but people still expecting a return to growth. As far as how that growth is expected to play out in 2025, and on average, the anticipation is that the growth is going to be back half weighted. The context that we talked to are expecting the first quarter to still be similar to what we saw in the fourth quarter from a sales perspective, down on that low single digit range. And then we're anticipating that sales do inflect a positive in the calendar second quarter and accelerate into the back half of the year. So overall, we do expect a recovery in 25, expect the trends that we're seeing here in January of stabilization and, a bit of inflection positive on the quoting to continue to support sales improvement as we move through the year. But I think it is worth highlighting, given the overall tariff environment, quite a bit of uncertainty still in the air. So we did want to provide a bit of a base case or a bear and bull case scenario here. Just bringing this chart back up again, if you, again, look at when the tariffs on China were announced in 2018, that really put a pause on the industrial recovery and actually sent it back down into a slowdown. So I think it is, while we do see recovery happening right now, distributors are sounding more optimistic. I do think it's worth having, a bit of caution given the uncertainty that come with tariffs. But we still think that there's a pretty narrow range of outcomes here in 2025, and that all of those outcomes still incorporate some kind of recovery here. So here the yellow line, shows that 3% growth that we anticipate in our forecasting as our base case. And then the red and green lines showing the kind of upside and downside there. The green line, suggests sales could accelerate even faster, potentially mid-single digit growth, 5% plus. In that scenario, we would see, the tariff, situation significantly de-escalating, no tariffs on Canada or Mexico, and only the current tariffs on China moving forward. Whereas the red lines show a pretty different scenario. That would assume we do see tariffs moving forward, escalating on Canada and Mexico, and rates not coming down. So as you can see, a bit of a difference in potential outcomes there, but still all moving up and to the right as we head into 2025 with a recovery expected in the back half of the year. So I think some of the key takeaways and things to plan for as you head into next year. First, plan for recovery. Even if it's slower than expected, we are anticipating sales to improve throughout 2025. Second, over-communicate tariffs and price actions. During the last supply chain crisis and inflationary environment, price increases and tariffs were changing regularly. And while it's really hard to keep and stay in front of this, and it may be bad news, but the thing that we consistently hear is, customers don't like hearing bad news, but the only thing worse than that is getting surprised by bad news. So the more you can get in front of that, make sure that they're expecting the price changes. Oh, sorry about that. The better they will be able to manage through the overall environment. Also want to make sure that you're focusing on tracking volumes rather than dollars to gauge the overall market. Just given the fact that, we are seeing price increases and, potential for more price increases with tariffs, I think it's important to make sure that you're still measuring the overall business based on the amount of volume you're moving. Because while, tariffs can add to the top line, generally don't see much profitability coming through on the tariff side. And then last, even though we are expecting a recovery, I think it's really important to be disciplined on the management of both inventory and costs. We've, like I said, the labor market's still really strong, but we saw in the last downturn, people were letting people go a bit too quickly. And then when things quickly rebounded, they weren't able to find talent, and it was really hard to grow and support the growth in that recovery. And so I think it's really important to make sure that you're being disciplined with costs, but not managing them too tightly. And on the inventory side, a similar thing. We are expecting a recovery, but with supply chains better than they have been in prior cycles, think that you can still be a bit more disciplined, more real time with inventory, and don't have to place those aggressive stocking orders. But with that, happy to answer any questions and talk through what you guys are thinking for 2025 here.
anyone have any questions? If you have a question, you can unmute yourself.
Hey, just to clarify, does it, that one slide, does it depend on who we're applying tariffs to could actually stunt the growth or actually relieve the growth? We're tariffing these two countries, but not that country, or this country and not those two countries?
I think there's, it depends. The answer is it depends. I think the overall concern would be that if we did announce 25% tariffs on Canada and Mexico, it would be less industry specific. And the concern there would be, hey, inflation as a whole is going to move up higher. The Fed is not going to be able to take rates down as quickly. So you're going to see, just a more challenging macro environment. Whereas if, the tariffs that are in place on China are the only ones that stay in effect, then would expect, a more subdued inflationary environment and, more potential for rates to move down. But I would say, like, as far as, the potential impact on competition, I think it does matter on who's being tariffs. We have heard increases in foreign competition a lot as a growing theme in our conversations over the last year. So I think, if those Trump recently announced he announced the potential to pass tariffs on India. So, we've heard a lot of foreign competition coming from India. So I think it would actually be viewed as a positive thing from a competitive standpoint for some of the domestic manufacturers. But I think the key thing that we're watching is really the impact that tariffs have on inflation rather than like the specific countries that are being applied to, if that makes sense.
Yeah, it looks like historical, we know what happens, right? That we've seen this before. It's kind of what that was showing. But I thought it was interesting to see the different countries that it played a part and what the outlook looked like. That's something new, right? Depending on what country and what percent, because we know what happened. We saw it. We've seen it before.
Yeah, I think that's why the Canada and Mexico are so important because they're both such a large part of our overall imports. So, if they do see tariffs go to 25%, with China, Mexico, and Canada representing, 43% of total imports, that would be a pretty big inflationary impact. So, the hope is that, on that front, you don't see an escalation with those two countries. But yeah, like you said, I think the industry adapted pretty well during the last environment. They were able to communicate really well and pass the increases through. In a lot of our conversations, I think people are like, hey, we're really confident we could pass these through. What I don't think they're paying attention to is, hey, this might slow the Fed's actions. So that's, the thing that stands out to us.
Right. Yeah. It's dynamic. It's almost volatile, dynamic and volatile at the same time. You just don't know.
Yeah, definitely.
Appreciate it. Thank you.
So in regards to the ag market and all the excess inventory, are they trying to add special deals, special promotions to clear that inventory and unplug the chain, or now they looking at, hey, we're sitting on a bunch of heavy metal equipment that our competitors are going to have to pay 25% tariff, and now we're going to be able to make some money on this inventory? How are they balancing that?
We are hearing that those dealers are getting more. They are offering more incentives. We actually heard in the fourth quarter that a lot of those dealers actually did some level of inventory write-downs to try to show some progress there. But yeah, as far as the tariffs go, I mean, certainly not an ideal situation for the end market because they likely would have to pass those on even if it is sitting in inventory. So ag, I think overall, right now that 3% outlook that we have across the overall FPDA, membership, if you stripped out ag, I think that would be a much higher outlook. People are probably thinking, high single, low double-digit growth, but just given that, ag is, 10 to 15% of the overall, spend, but potentially, with the magnitude of the movement and weakness, kind of having a pretty meaningful drag on the broader impact and broader industry.
So I have a question. What is your outlook for the oil and gas industry as we're going forward in 2025?
Yeah, that's been an interesting one. I think in a lot of our conversations, there's been a ton of optimism and quoting activity. I think people are, excited about the new administration, a lower regulatory environment. It seems like the actual rate that's kind of converting into spend seems to be a little bit slower than anticipated. But overall, that is a market that, we have seen it inflect here. It does look like it's, heading for recovery, but kind of a bit slower than we would have expected as far as actual spend so far. Hoping that, that quoting activity we're seeing ramps more meaningfully moving forward. But, I think people are waiting to see if, the overall economy, the consumer, if there's concerns around, their spend, that could weigh on overall production. But I do think people are excited about the drill baby drill sentiment of the new administration.
And what about the steel industry?
Steel is another one where that's probably one of the markets where we have heard an inflection. Mining, we've heard, a lot of investment going, from our distribution customers who deal with steel, steel companies. We've heard that they're really ramping spend. They're trying to they're trying to ramp capacity here in the United States, in case tariffs go into effect. At any level, the expectation is that demand domestically is going to be higher. So we are hearing steel companies are ramping their CapEx.
Thank you.
Awesome. Well, if there aren't any other questions, I think that's it on our end. And again, just want to kind of take the opportunity here to really plug, the Fluid Power Monthly Trend Survey. I think it's a great value add for members. And again, the more people that participate, the better the output. And, we send the results to all those who take the survey. So, want to get more members involved and, keep you as informed as possible here.
Thank you so much, Owen. I want to remind everyone, I've had a couple questions in the chat. If the recording will be available, and it will hopefully by Friday, be on the FPDA website under the Education tab and click on demand. And Owen, with your approval, I can share the slides to the group that attended today as well.
Perfect. And we'll be sending out the January survey results shortly here as well.
Thanks,
Thanks,
Owen. We
everyone.
really appreciate it.
Yeah.
Thanks. Have a good one.
Thank you. Thank you.